Bitcoin just did something gold has never wanted to admit was possible. In the span of a single trading session, the world's oldest safe haven and its newest digital rival appeared to send the exact same warning signal to every investor watching the charts. That warning is still echoing through global markets today, and what happened next made it impossible to ignore. Because barely a day after gold's shocking reversal, silver quietly joined the conversation, moving in a way that turned two assets into three. Yesterday, we watched gold's rally shatter in a matter of hours. What looked like an unstoppable climb toward record highs suddenly reversed into a wave of selling that wiped out billions of dollars almost overnight. We traced that shock back to the bond market, where real yields were rising just enough to make gold's lack of income suddenly matter again. We also uncovered how Bitcoin, once dismissed as a purely speculative asset, had started reacting to the same macroeconomic pressure points that have driven gold for decades. The deeper story wasn't really about a single red candle on a price chart. It was about whether confidence in the world's monetary foundations was quietly shifting beneath two very different forms of money. If you found yesterday's breakdown of gold and Bitcoin's strange new relationship useful, make sure you're subscribed, because today's episode adds a third player to that story in a way that changes the entire picture. What's happening right now isn't just about crypto brushing up against gold's old territory anymore. It's about an entire asset class, old and new, physical and digital, suddenly speaking the same financial language at the same time. And the moment silver entered that conversation, professional traders started paying very close attention. For most of modern financial history, silver has lived in gold's shadow. It's been treated as the smaller, more volatile cousin, a metal caught awkwardly between industrial demand and monetary symbolism, never quite trusted as a pure, safe haven the way gold is. Yet in recent trading, silver began mirroring the exact pattern that had just played out in gold and Bitcoin. As real yields shifted and the dollar wavered, silver didn't behave like an industrial commodity reacting to factory orders and solar panel demand. It behaved like a monetary asset, moving in step with the same fear and the same relief that had just rattled gold and crypto markets within hours of each other. That single detail is the reason analysts across trading desks started using a word they rarely apply to three assets at once: correlated. When gold, Bitcoin, and silver start moving together, it stops looking like coincidence and starts looking like a signal about something bigger happening underneath the surface of the financial system. Institutional investors don't celebrate coincidences, and when three assets with almost nothing structurally in common begin reacting to the same pressure on the same days, professional money managers start asking whether a genuine regime shift is underway. Wherever you're watching this from, drop your city in the comments below, because this audience spans more countries than most people realize, and this story is unfolding in real time for all of you. To understand why silver suddenly joined gold and Bitcoin in sending the same message, we need to look at what makes silver fundamentally different from both of them, and why that difference might be exactly what makes this signal so significant. Silver occupies a strange dual identity that neither gold nor Bitcoin shares. It is mined and traded as a monetary metal with centuries of history as a store of value. Yet more than half of global silver demand comes from industry, from solar panels and electronics to medical devices and electric vehicle components. That dual nature usually makes silver behave unpredictably, torn between industrial cycles and monetary fear. So when silver starts moving with the same conviction as gold and Bitcoin, both of which have no industrial demand pulling them in a different direction, it raises a very specific question that we're about to unpack. What does it mean when an asset with 1 foot in factories and 1 foot in vaults suddenly chooses to stand entirely on the monetary side of that line? That question sits at the center of everything unfolding right now, and the answer begins with a number most casual investors have never heard of, but every serious commodities trader watches closely. It's called the gold-silver ratio, a simple measure of how many ounces of silver it takes to buy a single ounce of gold. And throughout history, it has acted like a pressure gauge for the entire precious metals complex. For most of the past century, that ratio has swung between extremes, occasionally stretching to levels that made silver look historically cheap next to gold. When the ratio widens too far, it often signals that silver has been left behind by a monetary rally that gold captured first, and that gap has a long history of eventually closing, sometimes violently. What makes the current moment different is the speed at which silver began catching up once gold and Bitcoin sent their shared signal. Normally, silver's monetary side reacts slowly, lagging gold by days or weeks as industrial traders and monetary traders fight for control of the price. This time, that lag compressed dramatically, and the move happened almost in parallel with gold's shock and Bitcoin's macro pivot. That compression matters more than casual observers might assume, because it suggests silver's monetary identity briefly overpowered its industrial one. At the exact same moment, two completely different asset classes were already flashing the same warning. To understand why that overpowering happened now, and not during any of the countless other moments over the past decade when gold and Bitcoin moved together, we have to look at silver's supply side, which has been quietly tightening in ways the broader market has been slow to notice. Unlike gold, which is primarily mined as an end product, most of the world's silver comes out of the ground as a byproduct of mining other metals, particularly copper, lead, and zinc. That production structure means silver supply doesn't respond quickly to price incentives the way a pure silver mine might. If prices spike, miners can't simply flip a switch and produce more because the decision to expand output depends on economics tied to entirely different metals with their own separate demand cycles. Meanwhile, industrial demand for silver has been climbing steadily, driven largely by the global build-out of solar infrastructure, a sector that consumes meaningful quantities of silver in every panel produced. For several consecutive years now, total global silver demand has outpaced mine supply, a structural imbalance that analysts have flagged repeatedly, even while price action failed to reflect the shortage in any dramatic way. The disconnect between fundamentals and price is exactly the kind of setup that tends to resolve itself eventually, often triggered by a catalyst that has nothing directly to do with the underlying supply story. And that's precisely what appears to have happened here, where a monetary shock originating in gold and Bitcoin markets seems to have acted as the spark that ignited a structural imbalance silver had been carrying quietly for years. If this is starting to connect in your mind the way it did in ours while researching it, do us a favor and hit the like button, because it genuinely helps this channel keep bringing these hidden connections to light. Institutional behavior adds another layer to this story, one that mirrors exactly what we discussed with Bitcoin's transformation from speculative asset to macro hedge. Silver has increasingly found its way into exchange-traded products and diversified commodity portfolios managed by the same institutional players who allocate to gold and, more recently, to Bitcoin. When those portfolio managers run their risk models and see three assets suddenly correlating around the same macroeconomic fear, currency debasement, fiscal instability, and eroding confidence in traditional monetary anchors, silver stops being treated as an industrial afterthought and starts being treated as a core piece of the same hedge. That shift in perception can move billions of dollars in allocation decisions, and it happens far faster than most retail investors realize, often within the span of a single trading week. Once professional capital starts viewing silver through that lens, its price behavior increasingly detaches from short-term industrial demand swings and aligns more closely with the same forces driving gold and Bitcoin, which brings us to the most important question of this entire episode. If three fundamentally different assets, one ancient and physical, one industrial and monetary, and one entirely digital, are now moving in response to the same underlying fear, what exactly does that fear reveal about the state of the global financial system? And more importantly, what happens next if that fear continues building instead of fading away? To answer that question, we need to step back from the individual price charts and look at the bigger structural forces sitting underneath all three assets at once, because none of this is happening inside a vacuum. Government debt levels across major economies have continued climbing to levels that would have seemed extraordinary a generation ago, and the cost of servicing that debt has become an increasingly central concern for policymakers everywhere. That shift carries real implications for how the next decade of monetary history might unfold. If confidence in fiat currencies continues eroding gradually rather than collapsing suddenly, we may be watching the early formation of a new kind of safe haven complex, one where digital scarcity, physical metal, and industrial necessity all reinforce each other instead of competing for the same narrow pool of monetary fear. Central banks find themselves at the center of this tension, whether they want to be or not. Every decision about interest rates now carries a second layer of meaning beyond simply managing inflation or unemployment, because each move also signals something about a government's ability to keep borrowing at sustainable costs without triggering exactly the kind of confidence crisis that pushes capital toward gold, silver, and Bitcoin simultaneously. That's not a comfortable position for policymakers, and it's part of why markets have grown so sensitive to even minor shifts in central bank language. A single sentence in a policy statement can now move three completely different asset classes within minutes, something that would have seemed almost impossible a decade ago when gold, silver, and Bitcoin still lived in separate financial universes. For everyday investors trying to make sense of all this, the temptation is to treat each asset in isolation, chasing whichever one moved most dramatically in the headlines that week. But the far more valuable lesson sitting underneath this entire story is learning to watch the relationship between these assets rather than their individual price swings, because that relationship is often the earliest signal of a bigger shift, long before it becomes obvious to the broader public. If you've made it this far, you already understand something most casual market watchers still miss, and that puts you ahead of the curve heading into whatever comes next. Make sure you're subscribed so you don't miss the moment this story develops further, because The forces we've traced across these 2 episodes haven't resolved themselves, they've only just started revealing their shape. None of this guarantees where prices go from here, and no responsible analyst would claim certainty in a system this complex. What the evidence does suggest is that the old boundaries separating monetary metals, industrial commodities, and digital assets are becoming increasingly blurred, replaced by a simpler and more urgent question that all 3 now seem to be answering together: whether the world's confidence in traditional currency systems is quietly, steadily shifting beneath our feet. Maybe that's the real takeaway hiding inside all of this uncertainty, that even as the ground shifts beneath the world's oldest and newest forms of money, people everywhere are still doing what they've always done, looking for something solid to hold on to and trusting that careful attention will reveal the next chapter before it fully arrives. That's exactly why we keep building these stories together, one signal at a time, one hidden connection at a time. If gold, silver, and Bitcoin speaking the same language surprised you the way it surprised us while putting this together, hit like, drop a comment with your thoughts, and share it with someone who still thinks these 3 assets have nothing to do with each other. And as always, let us know in the comments where in the world you're watching from, because seeing just how far this story travels never gets old, and the next chapter of this saga is already forming beneath the surface, waiting for us to bring it to you.